Hello, welcome to class. Today is episode 2, focusing on borrowing and lending with Wildcat Finance. So, to get started, imagine you need a $10,000 loan to cover the cost to launch a small business. You decide to go to the bank. Here's what that looks like. First, you visit the bank's website or branch and start the application. You're asked for your full name, address, social security number, proof of income, for example, pay stubs or 2 years of tax returns. You have to go home and dig through drawers for these documents, and maybe even call your employer for verification. Just filing for the loan takes an hour. Next, you fill out forms detailing your job history, debts, and why you need the money. The bank pulls your credit score. Say maybe it's 650. It's not perfect, but it's a credit score that many Americans have. Sharing this personal information feels incredibly invasive, and you're already nervous about rejection. You submit everything and wait. Days pass, sometimes even a week. The bank calls. They need yet another document. You scramble to grab that document. Finally, after 10 days, you're approved. But the terms suck. It's a 15% interest rate because of your low credit score, plus a $200 origination fee. You'll pay $300 a month for 4 years, totaling over $14,000. One missed payment and your credit score tanks, or the bank slaps on penalties. This is traditional finance. Slow, intrusive, and costly. Banks act as gatekeepers, deciding who's worthy based on stacks of paperwork. For individuals, it's a grind. Now, let's talk about institutions. Institutions also need to borrow money. These institutions include hedge funds or corporations. They don't bother with retail banks for small loans, like your average retail borrower that we've illustrated the journey for previously. Instead, these institutions tap into private credit. Private credit is when institutions borrow large sums, often in the millions, directly from lenders like other funds or wealthy investors, bypassing public markets. It's tailored, flexible, and discreet. No stock exchange involved. Why do institutions borrow big? To seize on opportunities, like buying assets, funding trades, or scaling operations, without needing to liquidate their holdings. A hedge fund might borrow $50 million to jump on a market dip, promising lenders high returns. Private credit thrives because it's fast and custom, but it's also exclusive. Only big players with strong reputations or collateral can get a seat at that table. Now, enter blockchain-based lending. This flips the status quo on its head. For example, Aave, a platform for individuals like you and me. With Aave, you connect with a crypto wallet. No ID, no credit check necessary. You simply lend coins like USDC to earn 2 to 10% interest. Want to borrow? Deposit collateral, maybe $15,000 in ETH to borrow $10,000 in USDC instantly. Repay when you want, but watch out. If your collateral's value drops, it could be sold off. Aave's fast and global and runs on Ethereum. There's no bank and no hassle involved. But what about institutions? That's where Wildcat comes in. Wildcat is built for private credit. It lets big players like funds or, for example, DAOs create their own lending markets on Ethereum. Picture a hedge fund that needs $5 million. They deploy a market and choose an asset. For example, take USDC again. The interest rate is, say, 12%. And they can define rules, like who can lend or if collateral is required. Unlike Aave, Wildcat doesn't demand over-collateralization, so borrowers can access big sums based on trust or reputation, just like off-chain private credit. Lenders, think other funds or crypto whales, deposit funds if they like the terms, earning that 12% return. Everything is on-chain, so deposits, rates, and repayments are crystal clear. Core features that make Wildcat stand out include the ability to customize, where borrowers set every detail, rates, lockups, and access lists. There's no middleman, it's completely transparent, and there are isolated markets, meaning that risk one borrower's default won't crash others, and that keeps the risk contained. Nice. You managed to hit the vape before the
I'm
before
gonna
the
hit the vape during
started.
the podcast as well. I promise you.
Amazing. Hello. Welcome today with Dr. Laurence Day. Nice to see you. Where are
Indeed,
you
indeed.
calling from?
I'm up in Newcastle, which is the like northernmost city of God's most hated country, in the UK.
I think
It's
that makes
actually really nice weather. You would think that up here would just look like Mordor, but it's like a really beautiful, clear day. And I'm sat inside on a bed in my spare room sweating. So like, but for my sins, this is what I get to do with my life.
yeah, being in crypto is a little bit of punishment. Okay, cool. Let's get started. I'd kind of love to start with the name Wildcat Lending. So
Yep.
Wildcat comes from the Wildcat banking era. Can
Yes.
you talk more about Wildcat banking and how that led you to build Wildcat Lending?
So during what was called the the free banking era of the 1800s in the States, there was this kind of this like relentless push for westbound expansion, and obviously like beyond things like infrastructure for like transport or like fuel or whatever, the thing you need to do was money, right? You needed to actually like be able to put money like places and just like move it around because everyone was a capitalist even back then. And so what you found was because there wasn't really any regulation for these, that you would have these kind of banks that would set up in the middle of nowhere. Um, they were called Wildcat banks. Like, there's some apocryphal reasons, but I think it was just because like the only things that would ever go and visit were wildcats, where like they would issue script notes. So you would leave your money with them, and they would give you some debt that you could like some paper money that you could go and like notionally trade. Um, the I think the problem with these is that because they were so far out in the middle and they relied on trust and reputation, that people started playing silly buggers really quickly. So like you'd go in and you'd be like, "Can I see the collateral, please?" And like the box of silver coins would just be like a layer of coins with some like iron nails underneath it, etc. But that didn't mean that they didn't like serve this really useful purpose for credit expansion as America tore its way west. So I mean, they were ultimately kind of like caved and like clamped down on, and what gave you the Federal Banking Reserve now.
Yeah.
And when like the term is used now by people like Elizabeth Warren, it is very much used as a slur, but it doesn't mean that they weren't useful for the time. And I do still think that crypto kind of in its current state could stand to do with more of the same. But that's not to say that actually Wildcat was originally the name that I picked when I started writing this. At the time, I was reading Harry Potter again, and I just called it Gringotts because I'm a deeply unimaginative man. So like things could have been really different had I not read like some work on free banking.
Yeah, there are a lot of little like Easter eggs in your website, so I highly recommend people go through the docs.
I'm really waiting for Peter Thiel to personally sue me for stuff that's gone on the landing page.
Fingers crossed that doesn't happen. This is actually a question I was going to ask last, but it kind of makes sense to ask now, given your mention of Elizabeth Warren turning Wildcat banking into like a dirty slur.
Yep.
How would you pitch Wildcat to a traditional financial institution so that they feel like safe and secure using Wildcat?
I think it's probably quite easy to do so, right? Anyone that's got like a sufficiently complex like TradFi arrangement is aware that it be they a bank or a credit union or anything of the sort, knows that like when you're offering products, a lot of the stuff that gets offered TradFi, even if it's a mortgage or whatever, is collateralized or secured against things. But that doesn't mean that somewhere further out on the risk curve is just purely unsecured stuff, even though that generally requires like a huge amount of underwriting and due diligence. They do exist. Like they exist for like a non-trivial amount of like the total amount that's like handled. So if the pitch there is to make, okay, it is effectively a product that you already offer and collect fees on, it's just settled on chain in a much more visible way. Like we've been speaking to various banks that exist, like ones that perhaps want to invest in things like bonds
Interesting.
in sovereign nations or whatever. So it's not even a theoretical. Like this is happening now, where like you have entities that are like, yeah, this works for us. Like it's ground that we're familiar in. Maybe just on the regulatory side, people are like, well, what does this look like in terms of like how we need to structure it? But I consider that kind of by the by.
That is awesome to hear. Like, what compliance delays? They must have like some form of compliance.
Yeah, so the way this would generally need to look is things like who is allowed to lend to us using the platform, right? So
Sure.
would be there some kind of like accredited investor, or do they need to be like jurisdiction bound, or depending on the way that you phrase that you form like a wildcat market, um, which is just a name for a credit line between
Yeah.
arbitrary people and borrower, then it needs to look more like, do we need to be able to stop debt from being transferred? Do we need to have minimum deposits and so on? I think obviously, whenever you present this kind of stuff to a general counsel, they're immediately going to put a gun to their head.
Yeah.
But I think once they get past the fact that it's sitting on Ethereum, it's fundamentally not very different to what they're dealing with already.
Interesting. Interesting. Yeah, that was one of my questions is why deploy on Ethereum?
It's I mean I do
Most
believe in like
liquidity. Yeah. Yeah.
the holy machine of Ethereum mainnet, right? It's where like
Yeah,
most
absolutely.
activity is sitting. It's not like I'm averse to deploying stuff. Previous projects have ended up sitting on Polygon and on Arbitrum that I've tinkered with, but I just
Yeah.
think that as far as like the hub for where all the spokes are going to go from,
Yeah.
it just makes the most sense. I think our first version of Wildcat cost like $600 to deploy anything on it because
Yeah.
gas was so high.
Yeah.
But now we're all in like sub one Gwei that everyone's like, oh, it only costs $20. Like 17. So like it's basically just using an L2 anyway. So
That's the big
if you
takeaway.
yeah, and it's not as if we're like Solana ready because the code
Yeah.
base is written for the EVM. So if net like every bridge ends up hitting mainnet in some capacity anyway.
Yeah.
So it's not as if you're like pigeonholing yourself
Yeah.
into anyone,
Yeah.
which is the other one is that I just really like mainnet. I'm not too much of an L2 user. There are some that I'm like starting to use and appreciate more, but that's kind of where I've spent most of my career doing all of this.
Yeah. 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 Low activity on mainnet is good for uncollateralized lending, is the big takeaway for
Good
me.
for everything. Well, it's good for
Yeah.
everything if you don't want to spend $200 flipping NFTs.
Yeah, exactly. Okay, so let's backtrack a little. So most DeFi lending, like Aave and Compound, rely on over-collateralization.
Yep.
Why do you think uncollateralized lending has been the missing piece, and why choose to work on uncollateralized lending even though risk is highest?
Well, the answer as to like why do something different is that I do think that beyond mechanic design and things like there are some really cool things you can do with like reward structures and what have you that I generally consider the over collateralized lending space to be quite crowded.
Yeah,
And if you look at like these powerhouse teams that exist, like Euler, um, me and my small team are not going to be able to kind of like outmaneuver them in terms of like their ingenuity. So it's almost like what's the point in trying? Um, and so it's the same kind of thing where you see like there's like 100 different like perp dexes. Like the
yeah,
differentiation factor is so small.
yeah,
Now, I think the main reason, like from my point of view, being quite like credit build is very much as one of capital efficiency, right? If you're actually looking to like leverage up on your capital, or if you have things that you like, if you have decent cash flow and you just like that you're going to be good for it, and you can prove that to other people, it doesn't make sense for there not to be an option for you to. If your only option is to just dump a bunch of collateral into a vault and borrow against it, that leaves you kind of at a standing start because you might not have the money. And hitherto, or at least at this current cycle, as we record this, the macro market is collapsing like so much ash in the wind. The mechanism to do that just wasn't there. It's not as if I kind of like sat up and like bolt up right in the middle of the night and said, "Oh my god, I need to devote the next couple of years to my life to under collateralized lending." But I just like kind of a slow realization that like, well, no one's doing it. So, and sure, it's risky. I keep
yeah.
emphasizing this everywhere I go, but that doesn't mean it shouldn't exist.
Yeah. Yeah. And on the notion of risk, so Wildcat lets borrowers set their own terms,
Yep.
APRs, reserve ratios, lender whitelists, etc.
Yep.
How do you ensure that this degree of freedom just doesn't turn into a playground for reckless deals?
I think the answer is that as a protocol itself, it can't enforce. It allows these like mile wide avenues for things, but I think the overriding mechanism really just has to be like sensible self regulation from the market in terms of the supply from the lenders, right? So I won't pretend that there isn't a concern that you end up with this kind of like ratcheting up of rates to levels that people might consider to be unsustainable, even though like I think in certain environments, even getting into like anchor type levels of like 20% isn't actually that unreasonable, depending on um, what the capital is being used in service of, right? But I think that's very possible for someone to turn around and say, oh well, we want to borrow like a million ether, and we want to offer it like 30% or whatever, and then effectively just like default on it. But I do think, I mean, that's entirely possible to do, um, even if it's strategic, because someone decides that the amount that's borrowed is, worth more than like the trouble that they're going to incur by doing so. But I would like to imagine that you, me, and everyone else watching this, and everyone that's not watching this, for when people come back and like do the archaeological dig in a couple of years, that if someone sees something like that and they're like, well, who is this? Or like, it's too good to be true. And if there's anything we should know in crypto, is that stuff that says it seems too good to be true absolutely is.
Yeah, I think you've said before that like Terra influenced a lot of the
Yes.
design for Wildcat.
Yeah. So, well, or rather, it's not that it influenced the design, because that is a cursed thing to say.
Sorry.
But
Influenced how you thought about
I can
mitigating a
I
in
can hear the
total
Chinook.
collapse. Yeah.
I can hear the
Yeah.
cops like literally right now. It's more that there was clearly this desire to seek yield that was on the riskier side of things, during like the end of like the zero interest rate phenomenon.
Yeah.
And like 20% was a high number, right? And so, of course, Terra, like everything else, with its 1,001 days in the life of a turkey, worked until it didn't. But that didn't stop people from allocating to it, probably in amounts that were retroactively quite irresponsible, because they really just like drank the Kool-Aid. But Anchor aside, in terms of like its reward structure, that idea that like good quality private credit should and could like touch those same kind of amounts is a worthy one, right? It's not so much that Terra inspired Wildcat, but rather identifying that need or desire to diversify on the riskier side of things was present anyway. And so, how do you actually kind of give that a valve, as opposed to just letting it bubble away in over collateralized vaults for like rates that are just a little bit above the T bill overnight?
So how to give the highest amount of yield in the safest way.
Yeah, and like I'm not even sure that like giving the yield, right? It's basically just
Yeah.
allowing people to have these valves to say, well, look, we're looking for it anyway,
Yeah.
right? I think that the central conceit of Wildcat isn't even this like particularly like useful invention. It's just solving an information problem.
Yeah.
Borrowers want to borrow capital and don't know who will lend it to them, and lenders want to get a high yield and don't know who's going to ask for it. So if you put them all into the same place, then you find some kind of equilibrium.
Yeah. Yeah, it was interesting to see Wildcat and Royco kind of like both lean on some amount of, well, how do you match borrowers, lenders, people seeking yield and people giving yield.
Yeah,
Um,
yeah,
awesome. Are you ready for a little walkthrough of Wildcat? So
yeah.
how we use
Can do,
Wildcat? A
can
little
do.
screen share.
Just a quick walkthrough of the perspective of Wildcat from a lender, and you can decide whether you're going to be viewing it as a lender or as a borrower just by toggling this switch up here. Um, Obviously, if you're a borrower, then that's how you operate it from. Now, when you've connected a wallet, you will be able to see a list of markets that are in front of you from various borrowers seeking your credit. Right now, everyone that's being used is a self-onboard, which just means that you can bring yourself in and deposit, provided that you pass an OFAC check through Chainalysis. I can, I'll pick a random one. I'll go for the Selene USD coin market. So right up in front of me, this has just got an option for me to deposit some capital, and it says, well, nothing to claim because I've deposited nothing. I have nothing in this market at all. If I look for status, then all this tells me is, some parameters about the market. It tells me its name, any minimum deposits, how much interest's been paid, whether I'm allowed to transfer the debt token, and so on and so forth. I can get some details about the borrower, in terms of where they're based. I can get the history of the market, so we can see who has deposited, when withdrawals were made, and so on and so forth. Now, that's all well and good. I could deposit now, and I see, okay, there's a minimum deposit of 1,000, so I could just deposit into there. If I did that, then I would receive, in this case, SLN USDC. If I went to, say, a Wintermute market, then same kind of thing. I see all these parameters that are here. All of these are going to be different depending on the configuration of the borrower. And yep, about the borrower, same profiles here. These are all going to be fairly standard. Nothing really changes. It just kind of says, here's the capacities that are available and whether you want to deposit. That's it, really. trying to think if there's anything else that's worth covering. But fundamentally, they're all ultimately going to be the same. Pick your asset. You can filter by the APR. Check the borrower profile. See if there's anything in there by way of information. And then off you go. Cheers.
Then continuing on, so borrowers can whitelist lenders and make debt tokens tradable in DeFi. How do you
Yep.
see these features evolving, say with
Sure.
liquidity pools, reputation systems, etc.?
Yeah. So there's a couple of things that you can do on both sides of this, right? So the first one you mentioned is like they can whitelist their lenders, right? So how Wildcat works is that it allows for you to place hooks on how you enter. So the first version of Wildcat, which was like really, it was used by just one party. Um, it required that like someone you had to explicitly say on chain, this is the wallet that's allowed to lend to me. Like all five of these are allowed, no one else is. But of course, that's really hard if you're like just looking around looking to deploy yield, and you're like, well, I'm not going to go send them an email and go through due diligence just to like lend them my $20,000. Like it just doesn't make sense, and it drowns the operations team of whoever's receiving it. So you end up turning around going, okay, well, what's the like a way that you can check things instead? It's like, well, you could still remain this like individual like borrower whitelist, or you could do things like just do OFAC checks on Chainalysis, or you could do things more advanced which kind of lean into reputation systems. So it would be very easy to, for example, create a market that required that you had some kind of like builder score or a Gitcoin passport score that you could read on chain, or you had some kind of NFT. Like you could, I could imagine, and it would not be hard for example, Remelia Corporation to create a market that, like, the access requirement was that you have to hold a Milady in the wallet that you're depositing from. Like that's completely possible, like today. Um, so I think reputation is interesting then on like the borrower side. Like I'm speaking specifically on the lender side here about like what type of lender would you want to have. We can speak a little bit about like reputation of borrowers, but in terms of like debt transferability, so the way that debt tokens work, and I imagine we'll talk about them a little bit later, is that I lend to you one USDC and I get one Merry USDC in exchange, and that can be set up that either I'm able to trade it around as much as I want, or it's soul bound. Like it does its thing and then it waits until I repay it. Now, in terms of secondary market, like there may be regulatory reasons why that needs to be soul bound, based on the jurisdiction of the borrower, and that's fine. Like again, it's not a position that Wildcat takes. It's just like you do what you need to do. Secondary market wise, though, you could certainly see, and you see this with other protocols that do have this kind of like more like a peer-to-peer model where like a debt token is issued of things like pendle markets, right? Where you could say, oh, I'm going to split this debt token up into like its notional and its yield. Or you could start, I think something I'd be interested in seeing is you start seeing, for example, I guess, Wintermute is the largest borrower that's currently there. People to start trading like Wintermute USDC against USDC in a Uniswap pool, right? Because these things notionally should trade at something like 1-to-1 each. So it should be fine to do like for LP farming. But of course, the market should, if it's being sensible, always price something a little bit lower than one for debt, because there's always this chance, no matter how small
Yeah.
the chance is of default. So there needs to be this discount factor that applies. And so I'd like to see that stuff kind of like, turning up to happen. I think in like the far more advanced setting, I'd like to see things like curve pools turn up, where you like are able to kind of chop and change into like multiple different borrowers' debts, or even like different assets from the same borrower. Because like a curve pool can allow you to do like, wrapped Ether and USDC and Coinbase wrapped Bitcoin. If you start like being able to like trade the debt in those, I think that would be really cool. Beyond that though, like I think the real apotheosis of this would be to then take something like, yes, we will take like the borrower debt and have that as collateral on a market like Euler, so that you could borrow assets against debts. But I think that's, at least at this current stage, getting like pretty far up the Jenga tower. But the thing is, like, all of this is theoretically possible.
Yeah. Yeah.
I'll be excited to see if it actually does, kind of down the line.
Yeah. Open experimentation.
Yeah,
Yeah.
well, exactly.
So you've kind of emphasized previously that counterparty risk is very real with Wildcat. So what
Yep.
advice would you give lenders to diligence a borrower, where there's no, like overarching authority?
Yeah. I think the first one that I give is to diversify if you were going to engage at all, right? Like, again, I alluded to the fact that like the reason that so many people go in so much pain with Terra is that they just full stacked into things that they considered to be incredibly like, plus plus EV when they really weren't. Um, in terms of diligencing borrowers, obviously we had this problem in the last cycle where there were people that were effectively lending sight unseen to borrowers that were considered like primo grade. Three Arrows Capital is one of them. Alameda Research was like another one, and that was in spite of, or perhaps because of, them just like not refusing, not providing data for them, for like their positions, and everyone just going, oh well, you guys seem pretty funny on Twitter, go for it. Now, at least for for parties that are seeking to borrow that are perhaps like operate on chain, or that you can kind of see them moving around, like market makers that operate, you can kind of like make a rough inference about how much they're making in terms of profit. And generally, there are like the most autistic people in the world that are tracking their positions and like posting them on Twitter anyway.
Yeah.
So you can imagine a situation where like it becomes easier, if not maybe not for me as like my like midwit position. If I look in and I go, yes, this borrower is seeking to borrow like $500 million worth of capital, but I can only see them throwing around like 100 mil. That seems incredibly risky. But if you see that someone's sitting around with like most of 9 figures and is just trying to borrow like 30 or 40, you're like that seems like that's in their wheelhouse to cover. But even so, right? I think the one thing I'd recommend is just like, yeah, don't full stack into everyone. Like there will, there are
Yeah.
options. There are options. Like diversify a bit. That's what everyone tells you. People also tell you that diversifying is a loser strategy. But I do think that at least when I don't know, man, I've been corrupted by so many various stock picker books over the years.
Yeah. Yeah.
I think I don't know which way is up anymore. But
Q Q Q.
yeah,
That's the ticker recommendation.
you're done. You're finished. You can diversify. Just go all into QQQ. You're fine. But I think there should be this kind of wider public push for if there are parties that are looking to borrow capital, and it's just unclear as to um, how they're going to be good for it, is to just demand some more information, be it through some kind of like proof of reserve system or just kind of like selective revelation of data that you can actually prove, as opposed to relying on the Three Arrows Capital NAV letter, that PDF. Like I think things you should be asking for more than that. And if people perhaps aren't willing to, or if you can't generally get a good sense that this is like how risky this is, you just shouldn't engage.
Yeah, yeah. So, kind of related, but I think that aspect is so interesting where Twitter creates like this false reality where there was a lot of high trust in SBF,
Yep.
Three Arrows as well, just
Yep.
because of their Twitter presence. How are
Yeah.
you getting that? Why did you initially decide to start growing your Twitter presence?
As in, like, personally,
And what was your initial reaction as well?
uh, a lot of confusion on my part as to like why I was ending up like getting noticed on Twitter. I joked before that it is just autism and mental illness that has been this like combination of things. And
The
I won't
aura,
pretend that.
yeah, as
Yeah,
the yeah.
the dark triad of like Twitter personalities is like autism, mental illness, and not getting much sleep. But I think I won't pretend that you don't feel the pull, right? To be like, okay, cool, like people trust me, what can I get away with? And I certainly imagine that figures that ended up kind of tragicomic in the previous cycle ended up kind of falling for that, where like you can drink too much of the poison and be like, oh well, I am actually like a little bit of a master of the universe.
Yes, yeah,
I think it's very possible. Like, I mean, I'm pretty grounded that like I don't imagine I'm gonna fall for that trap. And
yeah.
it's not as if like no matter how like popular Wildcat gets, I lead Wildcat Labs, which does not control the protocol, and the money that goes into it is not something that like or anyone else in the labs can control. So I'm just like, cool, it's a number go up thing. People are finding it useful,
Yeah.
and like it's being used by other parties rather than me. Um, but with that said, I do think that the worm does kind of burrow around a little bit about, does this just end up being something that effectively facilitates another round of this, where you get people that kind of establish these high trust environments and leverage into it. It's one of the reasons why Wildcat currently doesn't permit individual people to be borrowers. And the paranoid thinking that I had at the time when I was suggesting that this was the policy that was to be followed
Yeah.
was because I didn't want people like BitBoy
Yeah.
to be able to turn up and be like, or PolioX
Yeah.
or whoever else to go like, oh yeah, hey, I'm doing a raise for something, can I have $10 million, and then just like
Yeah.
disappear into the deserts of Arizona, because you know that like the way that like cult personalities work is that they would probably get what they wanted.
Yeah.
It would be insanely dangerous.
Yeah, yeah. No, that's such an interesting aspect. I was actually talking with a friend about customizable financial products for communities and how creators, right, like are more like they could theoretically launch their own financial products, and then you could
Yep.
have like a Mr. Beast savings account, right?
Yep.
Like if people would actually like contribute to that.
Yeah. There have been more than 5 people at this point that have said, hey, we'd really like to use Wildcat as effectively like their own bank. Like they create a market and they use it as a credit line to draw down on and repay. And I think that's like a really cool idea. I
Yeah,
think it's so much harder to kind of effectively like underwrite a person, just because like a company, like companies can have like their dire events like as quickly as
right.
anyone else, but I think people are even more fallible, like susceptible to this kind of thing.
Yeah. Yeah.
To just have just like it just takes one bad day, right,
Yeah.
and change everything so much. um
The
I
legal
think
liability on that sounds crazy. Right?
I
If
mean,
like,
so
you do it
as
as
long
an
as it's
individual versus like an
It's, I
entity.
think as long as it's sufficiently disclaimed, then effectively you could do what you want. But the one thing you absolutely don't want to do is end up effectively allowing for like sanctioned parties like globally
Right.
to end up like creating markets and being like, hey, I'm Steve and I'm looking for money for a mortgage, or like basically facilitating things like pig butchering scams on chain, like using
Yeah.
a credit market. I think that gets like pretty dangerous.
Yeah.
Um, so like I would like to eventually, in some capacity, suggest to the protocol that it adopts some kind of mechanism that 3Jane is one that's doing this is like constrained specifically to America, that I think is really it's going to do absolute gangbusters. It's a great idea that kind of works on this, like borrowers are allowed to do this, like become use the pool as their own banks. I would love to see Wildcat variants of like Laurence USDC eventually turn up. I think that would be very cool and fun. Just not quite yet.
And then last question, maybe. So you finished up law school, right? You're
Yes,
now officially a JD
yes.
or
Well,
UK
an
equivalent
LL.
or okay, okay.
Yeah, yeah.
Yeah, I don't know what they call it in the UK.
I
But
can't, I can't even. So I was about to try and say the Latin name, and then I remembered that I immediately forgot as soon as I graduated. So I'm not going to embarrass myself.
you did that like alongside building Wildcat, which is huge,
Yes.
and also having a child, which
Yes.
is a lot more responsibilities than I can ever imagine having.
Well, as I keep saying, like, I've got 8 days from now, I've got the twins coming as well. Whilst we go into like the BD growth stage
Wow.
of Wildcats, I had I'd signed up for law school and said, okay, well, what does life look like without children? And then basically, like 2 days after I paid tuition, they were like, oh, by the way, the child's coming on Valentine's Day. I was like, oh, okay, bet. So I had to write quite a number of my exams with my kid on my knee, which was actually quite sweet.
Maybe you can be the first individual borrower on Wildcat.
Yeah, the one man who's capable of doing so.
Yeah, yeah. How does your legal lens influence your view of DeFi's regulatory future? How do you pre-anticipate Wildcat's place in it?
I think all it's done is it's made me very paranoid and uncertain. I think there is
It's
such a thing as I think there is such thing as too much knowledge when it comes to this, because a lot of the regulatory environment, at least right now, especially right now, even in the States, is that we're starting to see blockers kind of like get pulled up, and enforcement actions basically being like pulled away, or focuses being moved. But that doesn't mean that, like, I think Micah is a really good example in the European Union of you're starting to see how entities such as Tether are like starting to like kind of like push against, like just bounce against the edges of that, and
Yeah.
really struggle. And I think there's the Stable Act that's happening in the States, but yet there's not still really been any kind of like novel treatment of how DeFi should be handled. And I think it's just because it's such a wide spectrum
Yeah.
that it's really difficult to kind of like peg down in just one bill,
Yeah.
right? Even when it comes to things like what does like yield look like in terms of treating, like handling that from like a tax perspective, is the kind of thing that like drives people to madness.
Yeah.
So much less things like, oh, what should we be doing about these loops leveraged NFT trades, is just like it's insanity.
Yeah.
Now, I think what law school got me was it meant that I was able to do much funnier legal posts on Twitter. just like in the shit posting vein. And I can certainly like read contracts a little bit better in terms of these are the promises that you should be making.
Yeah.
We're kind of like locking down some of like the gaps in what is effectively a legal agreement when it comes to under collateralized credit. Not just by myself, in conjunction with a bunch of very talented lawyers from all around the world who helped like draft stuff. But I won't pretend I think that I'm any more or less capable than anyone else just because I wrote a couple of exams on European Union law. Because obviously nothing that I touched was like I didn't get a chance to do like banking and securities law in like the 2 year degrees. So
Yeah.
you know the fact that I know what an easement is in your freehold house does not necessarily mean that I am any better or worse when it comes to determining how like legal stuff should be treated. I think for that we have very capable people such as Gabe Shapiro who are able to do so, in a slightly more militant manner than I can.
But there shouldn't only be Wasi lawyer and Gabe Shapiro. So
No, 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 no,
with
of
legal
course.
experience,
I,
yeah.
I would like for every lawyer to be Wasi lawyer.
Yeah.
I think that
Yeah.
would make it a lot more fun
Yeah.
on the risk curve. But I think I think understanding the bare basics of this stuff, like especially in terms of how contracts work and when they're implicit and explicit in DeFi, I think really benefits people.
Yeah.
But I also think ain't nobody got time for that,
Yeah.
right? Like people have stuff to do.
Yeah.
It
Yeah.
is a new problem that I decided to go to law school over it. So
Yeah, but all the carve outs, right? Okay, so for example, like staking rewards are taxable. All of
yeah,
those things, it's like the normal person does not know.
yeah, exactly. Like, even me, like I live in the UK, and when I theoretically want to like exit a position such as if I use Wildcat myself as a lender, and from a tax perspective, what I have to do is I have to make two transactions. I have to make one transaction to withdraw the initial amount that I put in order to net out my deposit for tax
Yeah.
purposes, and I have to like put in another transaction for like my interest, and that's taxable with capital gains. Nobody's doing that. So like the fact that like even I'm probably not going to do that when it comes to it because I'm going to forget.
Yeah.
So like I think it's just you've got this kind of fairly rigid existing system. Like I mean, tax is completely separate from the law in terms of like how cursed it is.
Yeah.
But for that alone, it's just like yeah, good luck. Basically,
Yeah.
I will not be helping you with that in the slightest. Have a
Yeah.
great time.
Yeah, because all of those problems are also like very boring to solve.
Yeah, I mean they're
Or
important
went out
because
for
like
everyone building tax software for crypto.
I
Yeah.
don't think anyone watched building tax software for crypto has ever watched a crypto podcast in their life. I think that's probably safe to say.
And then last question. So, breaking it down in two parts. One, who do you want to try Wildcat today? Like, what is the type of user profile? Because I think a lot of people assume this project is like not for them, not targeted towards them. And then two, what experiments do you want to see built with Wildcat?
Yep.
Like we were talking about earlier with like reputation
Okay.
systems, etc.
Yeah, yeah. So the first one is, in theory, you watching this can use Wildcat now. Again, like we do have this strict policy of neutrality about like who is using it and for what purpose. What I will never do is say that you should like specifically lend to a particular lender. But what I will do is suggest that, in the weeks and months to come, you will start seeing a bunch more names of like parties that you recognize and maybe people that you don't.
Nice.
Um, and depending on the way that markets are configured, you are very likely capable, at least, of depositing yourself. Again, what I will not say is you should full stack things, but maybe do a bit of a kind of like rough calculation to yourself about like how much of your portfolio do you actually want to be like exposed to the riskier side with like the concomitant rewards for that. I think the first version of Wildcat was very much focused towards the lender side, being people on over the counter books, so like family offices, like DAOs doing treasury management or whatever. But the point of doing all of this is to make it open to all. So, of course, there may be regulatory issues in your particular jurisdiction that prevent you from doing so, or just like maybe like set up some red flares. And I don't know where you live when you're watching this, so I can't tell you what the answer is for that. But Joe Blogs should be able to access private credit, and hopefully Wildcat's the way that they can do that. Now, in terms of building stuff on top, I always say this line, and then like claxons just go off in a bunch of people's minds because the thing that always people want to go is like, well, what's the protection that you can offer against a default in credit? And the answer always becomes, oh, well, we have these. They're called credit default swaps. And then anyone who lived through 2008 just immediately like just has this like bolt of ice run through them because they recognize like that CDS were a big part of the global financial crisis. Now, with that said, anything in Wildcat is going to be fairly small potatoes compared. Like it's not going to be this like massive shock that gets run through. But I think it would be very cool and doable to do something like, here are the parameters of a market that exists right now establishing credit. Third parties can effectively start offering like credit default swaps, which are just basically bets that the market will remain solvent and paying its debts throughout X duration. So you might end up seeing some kind of like weird underwriting that happens like kind of from the outside, from like, you know, some party that's like, oh yeah, I'll sell it effectively insurance on like $1 million of a market that belongs to a particular market maker. I think that would be fun. I don't know what the downstream effects of that kind of thing would be. Other stuff is, you know, I think I really want to start seeing DAOs themselves use Wildcat.
Yeah, I
So
saw
one
that
thing,
in the white paper.
yes,
Yeah.
yeah, I think that would be so cool, right? Because right now, if you're a DAO or a DeFi protocol, you really are just kind of constrained to equity.
Mhm.
Um, if you are looking to raise capital, and obviously then like if your token is created, then you generally might want to like enter into some OTC deals or whatever. Like you have that optionality, but then you often end up with like a bunch of native tokens that may have liquidity, but you don't really want to sell those tokens like into Uniswap or Curve because then everyone gets mad, right? Because you're like, ah, cool, you've dumped the value of our bags. I think it would be very cool to allow for a mechanism which at Labs we're working on like now,
Mhm.
to allow you to, they're like, you know, take your DeFi token and use it as like on-chain backing. That like if you don't pay it back when demanded in the asset that's borrowed, you can just hit the hell with you, pay me button and liquidate it on chain through like, you know, a DEX and repay it. Now again, none of this is exciting, right? Or novel, but it's the kind of thing that I think is necessary. So in terms of, like the question was, what would you like to see? And the answer is boring infrastructure. Which I
Boring
think
is
is
good in crypto. It's very good in crypto.
it is especially boring when it comes to things like unsecured credit.
Yeah. Yeah.
Um, and I think the funny thing about all this is that like I talk about all this like need for boring, and then if you go and read my Twitter profile page, I'm a psychopath, which I think makes for like a fun little um divergence, real severance moment when I log in between like my two accounts. Um, and that, I really enjoy that because I think, you know, when you're shit posting on Twitter, it allows you to. Crypto is, I think, you know, all of its PR and marketing is often quite staid and boring, and like we are delighted to announce and we are
Yeah.
happy to present.
Yeah. Yeah. LinkedIn
Um,
style. Yeah. Yeah.
it is. It's LinkedIn for magic internet money,
Yeah.
and I think that what shit posting allows you to do is to kind of say something useful, but like wrapped in a layer of irony, because
Yes.
then people
Yes.
actually pay attention to it.
Yeah. Wholesome father of two, aggressive shit poster.
Exactly. Yeah. Inside you are two wolves.
Yeah. Okay, on that note, thank you for the podcast today.
You are very welcome,
Use
Mary. Thank you very
Wildcat.
much. You should use Wildcat. No, you are, but you should probably give it a go. Thank you very much.
I don't know.